Good morning and welcome everyone to NYSE TV Live. I'm Kristen Scholler here in studio above the trading floor. While stocks consolidate their gains after a post-election surge, we continue to follow the action driving markets. This week, it's retail earnings as we've been covering, including positive results from Walmart, which showed that shoppers are still willing to spend. Artificial intelligence giant NVIDIA reported last night, too. It beat expectations and issued strong guidance. Let's take a look at what's on tap in today's show. Intercontinental Exchange, the parent company of the New York Stock Exchange, is going to host its annual Fixed Income Forum today. We'll have more on that in a moment, including what to expect. Plus, with the Fixed Income Forum underway, the president of Fixed Income and Data Services at ICE is going to join me live in studio momentarily. And as we continue our coverage of artificial intelligence, the senior vice president of $35 billion NYSE-listed company HubSpot will be with us for more on the floor. Now, as we start our coverage with the state of the fixed income space, here's more on what we can expect. The annual gathering at the Fixed Income Forum today brings together leading ICE experts and others from across the market. Together, they'll look to tackle challenges and lean into innovation spanning the fixed income space. It will include insights on pricing, climate impact, wealth management, and mortgage markets. Well, joining me now with more is Chris Edmonds. He is ICE's president of Fixed Income and Data Services, and he's going to be part of a fireside chat at this forum very soon. Chris, it's great to have you on the program. Good morning.
Thanks for having me. It's great to be here.
Great to have you at the Stock Exchange today, and I think many of our viewers wondering, amid the decisive election victory just a few weeks ago, what is the state of the fixed income space?
Well, lots of opportunity in front of us. Lots of questions at the end of the day about where the Fed policy may go, the new cabinet coming in, how that will impact the economic opportunities that are out there that will then drive certain economic development and have an impact on all of that. It's interesting to see. Everyone has an opinion. I was just at the conference in Chicago through last night. Everyone wants to know who's going to fill what spot, and each of them expect each spot to have some impact on not only fixed income, but the economy here in the United States.
We follow Fed policy so closely, of course, as it relates to the stock market here at the exchange, but it has an impact on the bond market as well in the fixed income space. Amid the path that we see for interest rates laid out by Fed Chair Jerome Powell, what are you seeing in the space?
Well, certainly the expectation from the Fed as they began to cut rates, become a little bit more dovish along the way, we would see the rates go down. Inflation hasn't really, it's moving in the right direction, hasn't really gotten to where we thought it might be. So it hasn't moved as far down as quickly as some people expected. Now, new administration coming in, the idea of tariffs, the idea of maybe a little bit higher deficit in order to spur the economy along, that gives us some opportunity along the day to maybe see a little bit elevated interest rates. It impacts our mortgage market. Obviously, we have a big mortgage business here at ICE. But all of those opportunities give each of us a way to manage that risk. And that's fundamentally what we're here to do, is to help manage risk across the segment.
I'd like to talk about trade volumes as well. That does tell the picture of overall market activity, as you know well. What are you seeing in the small trade volume space?
Right. So if you look at the number of baby boomers that continue to retire each and every day, and their use of RIAs in the wealth system, each of them have some idea. And elevated interest rates, they want to lock in that yield as they come into retirement a little bit longer. These higher rates give them the ability to do that. It also gives the industry the ability to launch innovation around ETFs, fixed income ETFs, which has been a big growth area for us and for the industry as a whole. And that gives them the opportunity to take those pieces and put them in their portfolio in a little bit safer space.
Artificial intelligence is one of the buzziest words of the past 18 months, and I'm sure it is having an impact in the fixed income space as well. How are you seeing that in some of your applications?
Well, certainly it is an empowerment tool. It makes us more efficient at the end of the day. It takes a lot of laborious tasks that required lots of human hours and makes them more efficient. In the same amount of time, they can do a lot more work. So that's great. As we look at our pricing and reference data, our continuous evaluated pricing, the quality checks that we can do, all of that's great. However, it's still a human element. And for us here at ICE, we want the best of both. We want to use all of that technology to lever a better user experience driven by human involvement at that point in time. And so for us, it's a little bit of our story. It's about taking that innovation to the next level.
Some would say we are still in the early days of artificial intelligence. As the president of the fixed income and data services business within ICE, what do you see as opportunities that AI can lead the business toward?
It's our opportunity to empower our clients. They're going to want to train models. They're going to want to make sure they have the very best data inputs that are there. We represent that across a number of unique data sets. Each one of them will become more important, and as we continue to grow with our clients, we will continue to add unique data sets along the way to help them accomplish their goals.
What's on tap at today's Fixed Income Forum in your words, Chris?
Every year it's a way for us to check in as a state of the market. What did we see last year? Did it come true? Did it not come true? Hear some from the best customers that we have, our best partners on stage will explain to us what we thought was going to happen last year. Did it happen? Did it not? Did it change flavors? And I look forward to learning a lot across the segment today.
And I know you were just in Chicago at an expo as well. Takeaways from that event?
Lots on who's going to fill what space, lots on Treasury clearing, which we've announced we would enter that space as well, and what impact that will have on the market. Lots on innovation, lots on regulation. So all of those things out in front of us, and will require lots of effort from our team here at ICE and the industry as a whole.
What are the solutions that ICE is providing to clients?
Well, those are vast. I mean, I think it's probably easy for me to say we want to meet each client where they are. And so there are clients that we do, we'll say panel A, menu A with. Very different from client B where we do menu C with. It's about us providing enough of that opportunity to when they need something, we can earn their business, create a little value for our shareholders and make the world a little bit safer along the way.
And as we look ahead to 2025, what's on your radar?
Making sure that we're making the right investments at the right time and making sure we have the very best people possible representing us to our clients to make their user experience the very best it can be here at ICE.
Chris Edmonds, such a pleasure. Thank you so much for joining. A busy day, of course, for Chris and the team ahead. Chris Edmonds is Intercontinental Exchange's president of the Fixed Income and Data Services business. All right, well, stay with us because up next we will dive into the intersection of fixed income, mortgages, and climate risks with ICE's VP of Enterprise Research Strategy. Stay with us. So, John, tell us a bit about the partnership you have with Santander and Openbank.
It's a Spanish man and it's a Spanish company. This is my only Spanish partnership. Santander has a long history with the game of golf and being a professional golfer. It's a true honor to be a part of it. And then, well, we're here at the New York Stock Exchange for the opening, the soft launch of the new online bank here in the U.S. being Openbank.
Now, John, when deciding which brands you partner with, what factors do you consider?
I try to get brands that represent me in some kind of way, right? And trying to at least having the opportunity to partner with somebody from Spain, a family that grew up in northern Spain like myself, not the same city, but close enough, that has a close history with the game of golf. I thought it was a no-brainer, right? They've also been involved in other sports like Formula One and many others. I think that was an easy choice, right? But I think every brand I've had, I try to see what their expertise is, what their motto is, and what they portray to the world, right? And that's what I try to link myself with. So my image in itself, or what is the name John, is either uplifted by those brands or related to those brands, right? And I try to be picky. Luckily, I've been able to have some great partners to join with and keep on going on those ventures.
Now, Santander is growing in the U.S. market, which is a journey you yourself are familiar with. Do you see any parallels between your own experience in the U.S. and what Santander is doing today?
There is a difference when you're playing in different parts of the world. The golf courses are different, the setting is different, right? So to be as complete a player as you can be, you have to play in all different environments. And coming to the U.S. is a massive one, right? 3 of the 4 big majors are played in the U.S., all the big events are played in the U.S. So being able to come here
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. Well, this year's Atlantic hurricane season, especially hurricanes Helene and Milton of late, brought heavy storms and damaging conditions to the eastern U.S. The storms are also having an effect on the mortgage market. Joining me now with more is our resident expert in this space, Andy Walden. He's a Vice President of Research and Analysis for Intercontinental Exchange. Andy, great to have you on the show.
Appreciate you having me. It's great to be here.
Happy to have you. Well, as today's Fixed Income Forum gets underway, what topics are top of mind for you in this space?
Yeah, we're really going to look at the intersection between climate and the mortgage and housing markets. We'll talk about how that impacts collateral risk and credit risk in the market. We'll talk about some of those variable costs of home ownership that a lot of folks don't think about. For example, property insurance is up 52% over the last few years. We've seen increases in the cost of heat and cool homes across the country because of variable climate change as well. And so we're going to dissect all of those different things in a discussion today.
I think as people are looking at their budgets, especially as we head toward the end of the year, families start setting goals for 2025, obviously taking into account those variable costs when it comes to owning a home are very important. How has this impacted the overall cost by factors like insurance and taxes?
Yeah, and when you look at that variable cost of home ownership, it's easy to look at the mortgage market and say, hey, 94% of homes in the US have fixed interest rates, right? But when you really dissect the principal, interest, tax, and insurance components, that mortgage payment that you make every month, 1/3 of that expense for the average homeowner comes from taxes and insurance. Variable costs that we hope will come down over time, but they don't tend to do that. They tend to go up, right? And so when you look at property insurance rising by 52%, that can have a meaningful impact for homeowners and create pressures on folks, especially for folks that live on a fixed income, or some of your folks that have bought in 2022 or 23 and 24 that have bought at higher home valuations, stretch themselves to get into the home in the first place. When you start to see some pressure on those variable costs, it can create some credit risk for those homeowners and credit risk in the fixed income space as well.
How should investors use this information that ICE is able to provide?
Yeah, and that's a good question. And when you look at data in general and how we use it on a day in and day out basis, it's to make better, faster, more informed decisions, right? And that's what we're trying to implement in that fixed income space. It's easy to look at mortgage-backed securities or municipal bonds and look at them as homogeneous instruments where the climate-related risk is the same across each one of those different securities, and that's simply not the case. And so we're looking to shine a light on some of those variations in climate risk inside some of those securities to help folks in the fixed income space make better decisions in their day-to-day work.
How would you describe the state of the mortgage market?
Yeah, and when you look at mortgage performance, we just released our latest mortgage performance today as part of our first look. I think there's a couple things that stand out. One, as it relates to climate risk, you're seeing thousands of homeowners that became delinquent this month on their mortgage as a result of some of these recent hurricanes that came through the country. So you're seeing a direct connection between climate risk and mortgage performance out there in the market. More broadly speaking, when you look at delinquency rates, they're trending gradually higher. I think it's safe to say the best is behind us in this cycle in terms of mortgage delinquencies. Number of reasons behind that. But we're seeing a normalization, kind of this gradual rise in overall delinquency rates. I think we'll be having more conversations about mortgage performance over the next year or so, right? There's some specific areas, FHA loans, VA loans, where you're seeing some risk there, but broadly speaking, still in a good space in terms of delinquencies.
And in terms of what we expect ahead, right? Obviously, the Fed has put out its forecast for interest rates ahead. We have new leadership coming into DC as of January. How does that impact the way that you're looking at this space?
Yeah, and when you look at affordability, that's certainly an impact, right? The interest rate environment is one of those key variables that drives home affordability. That'll be a talk track ahead, and we're going to continue to see some affordability challenges in the market. When you look at the loans being originated, they're still having 6.5%, 7% interest rates. That's putting some upward pressure on debt to income ratios of folks and credit risk out there in the market, driving higher delinquency rates among more recently originated loans. So a number of different ways that interest rate environment impacts everywhere from originations to mortgage servicing to mortgage performance as well.
I'd be interested to hear, Andy, more about what's on tap at today's Fixed Income Forum, specifically the conversation that you are going to be having on stage.
Yeah, absolutely. And we're going to be digging into a lot of the climate aspects that we talked about already. I'll be on there with Larry Lawrence. He runs our climate team. He's got a vast array of climate-related data. It'll be an engaging conversation about exactly the things that we're talking about here, right? Climate impact on the mortgage and housing market, and the way that folks in the fixed income space can utilize that data to make better decisions.
And in terms of the right way to look at these decisions for people looking at whether or not homeownership is feasible for them in the new year, they got to adjust for all those variable costs. What else?
I mean, I think the same thing that the fixed income community is looking at from a risk perspective, from a collateral risk, what is this home going to be worth in the future? What's the ultimate climate risk of these particular properties, along with the traditional affordability metrics that we think of, and then certainly the variable cost of home ownership, right? When we look at it from a homeowner's perspective, we typically think of what does it take to get in the door. We don't think of what is this going to look like 5 years down the road, 10 years down the road. I think taking that into full context and understanding the long-term expense and the variable costs is extremely important as well.
My last question, Andy, is for our viewers. Explain how the mortgage market and the research that you do fits into the fixed income and data services space.
Yeah, I mean, it kind of fits everywhere, right? We talk specifically to homeowners out there. We talk to fixed income folks as well. I think a lot of the things, again, that homeowners are looking at, the costs associated with whether they can ultimately make these mortgage payments, what's their risk of ultimately not being able to pay those mortgages, that hits homeowners at home, that hits the fixed income community as well, and the investment decisions that they're making and whether they're investing in mortgages and at what rate they're requiring to make those investments as well. So the same thing that homeowners are feeling at home, those same analytics are going into the investment decisions that fixed income community is making as well.
Andy, always good to get your take. You join us at least once a month to give us the state of play here of the mortgage industry and what it means for our viewers. And we appreciate you joining in person today.
I appreciate you having me. Thank you.
That's Andy Walden, ICE's VP of Research and Analysis. All right, well, stay with us because up next we will count you down to the opening bell and talk about a major story in the media space. Comcast had an announcement yesterday, and we'll find out what the company's future could mean for cable networks. Stay with us.
Since we last talked, I know you have a major announcement. You just made the largest deal in the ASPM space. So talk to me.
Application Security Posture Management market, yes.
Yes. And I understand that it's with an NYSE listed company. We can't say the name.
Fortune 10.
Yes, Fortune 10 company. Tell me about this deal.
First and foremost, this is a deal that changes startups, okay? And we're super, super excited about it and why they decided to partner with us for 3 years. Very large deal was technology that we developed. We actually helped them automate all their security risk assessment questionnaires, build a real-time software inventory, and prioritize, remediate, and prevent risks before they get to the cloud.
Let's talk about how Apiro recently launched the risk detection at the design phase. Can you talk to me more about this and how earlier detection in the software development of these kind of problems will help enhance the security outcome for businesses?
Based on NIST, the cost of fixing a defect at runtime when it reaches to the cloud, 100x more than in the design phase. So what we did, we developed our own private LLM model that scans every feature requests that gets into the development lifecycle. And automatically, we generate threat modeling, stories, mitigations before one line of code is written.
I do want to talk to you about a new product that I know that you are going to be unveiling soon. Can you tell me more about it?
I can't share all the details, but I will say the following. We're using the Apiro deep code analysis technology to identify our software architecture. The next phase is to visualize your software architecture in a very, very interesting way. It's like a living and breathing organism. It changes every day. So you need to visualize it to help developers write.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. Well, on Wednesday, Comcast announced a major change regarding its cable networks under its umbrella, saying that it plans to spin off most of its cable TV networks into a separate publicly traded entity. Channels like CNBC, MSNBC, USA Network, and E will be part of this new firm. And Mark Lazarus, chair of NBC Universal Media Group, will lead the new entity. In a statement, Comcast President Mike Cavanaugh said that the transition will take about a year. Well, the Wall Street Journal's Media and Entertainment Bureau Chief, Amol Sharma, was the first to break this story, and he joins me now via Zoom. Amol, it's great to have you on the show. A $7 billion venture. What does it include?
Well, Kristen, you named a bunch of the cable networks that will be in this business. It's basically every cable channel that Comcast, NBC Universal owns, with the exception of Bravo. Bravo will stay in the mothership at Comcast NBC. And the main reason for that is that they found that there was a lot of overlap between the viewership of Bravo and the Peacock streaming service, and that is the future, streaming. So they wanted to keep Bravo in the fold, but everything else will go. You named many of the channels, also Sci-Fi, Oxygen. It's really cleaving off that entire business, almost all of it.
Walk us through the leadership changes that this entails.
Well, Mark Lazarus, who will be CEO of this new, as yet unnamed venture, he's a veteran of Comcast. He's worked in the sports media arena. He's been calling the shots on the TV business for several years. Very experienced. The view in the company is that they're putting a real steady hand on the wheel of this new cable company. He also, has done a lot of the core business functions that you'd need to do to run a cable TV operation. And he'll also take with him Anand Kini, who is a very experienced CFO at NBC and the head of strategy at Comcast, very respected in the company. And I think it's being taken as a signal, both by investors and people who work at Comcast, that this is a really serious venture with some hefty leadership atop it.
Well, based on your reporting, why was now the time to do this?
I think Comcast said on its recent earnings call, which was on a Halloween, so maybe some people missed it, that it was studying this. But I think people were surprised at how quickly they moved between that time and actually announcing it. And I'm told that they've been working on this for many months. It's just, I think the timing is that you want to find the right point where investors are ready to sort of take this on as, there's something that's going to happen when this is cleaved off where profits are going to go with it, right? These cable networks are still profitable. And you have to sort of sell to the investors that you can absorb all that and you can lose that profit. And Comcast is a big company with a very strong balance sheet. So they wanted to line up their ducks to make that case and do it in an orderly, managed way and make sure that the leadership pieces were in place as well. And I think that's what's been going on.
What does it mean for existing shareholders?
So this is structured as a tax-free spinoff to Comcast shareholders. So they will essentially own the spun-off company. They'll just have a clear look at it separate from the parent company. Over time, of course, it'll be a publicly traded company, so people can sell out of the stock and new investors can come in. But I think what it means is they'll get a clear look at what is still very profitable cable company that will reach around 70 million households across these channels. But of course, it's something that's not going to be growing. Cord cutting is going to keep taking a toll on subscriptions in cable and on viewership. And so they'll be able to evaluate the business as a short-term profit, long-term growth challenged operation.
And what can you tell us about the state of the business as it relates to cable networks, the streaming space, and the digital landscape?
There's two things to watch out for here. One is, I think this company is really going to have its best chance if it grows beyond what Comcast is putting into it. We've heard for years that there could be a roll-up of cable networks. Somebody could come in and take all these declining assets and put them together. And, popular wisdom on that would be, an Apollo or TPG or some combination of private equity. But Comcast sees this thing as a possible aggregator, so I think you look at whether maybe there's other channels across the cable dial that could wind up in this thing over time. And on the streaming side, look, the reason they're doing this is they want to focus, really purely on investing in streaming and in sports. And those are the things that are core to the mothership, to the parent company. And I think you see that across the sector too. That's what everybody wants to do. Not every company is in position to do a spinoff like this because they're not in the same financial position as Comcast, and some of them strategically don't want to, like Disney. But I think that those are some of the key dynamics here. Just it's all about streaming and it's all about sports.
Mm-hmm. Well, what happens from here?
I think with the Trump administration coming in and a new antitrust team coming in, we'll have to see how all of the things I just mentioned in terms of potential aggregation and M&A will play out under that regime. That will determine a lot of how big that company could get and how this deal moves forward. And I think you also want to see how companies like Warner Brothers Discovery react to this. Are there some networks that they would ultimately want to put into this venture, or would they want to do something similar? So I think there's just a lot of unanswered questions. Also, the NBC News operation is going to be split here. MSNBC would go into this venture, and that means that NBC News would sort of be cleaved, and also CNBC would go into this venture. So those things are pretty tied together now, and I think we'll wait to see what impact that has on the business, any lost efficiencies or scale benefits that come with being together at NBC Universal now. So that's another thing we'll look at.
Amol Sharma, great to get your take. Thank you so much for joining. Great to see you. Amol's the Wall Street Journal's Media and Entertainment Bureau Chief. All right, well, stay with us because up next we will have the opening bell down here on Wall Street and all the market action you need to know.
Brett, we're here at the New York Stock Exchange. You're here with the Startup Challenge by Snowflake.
Yes.
So tell me, what were your key takeaways from this competition, and how do you see these insights influencing Big Geo's journey forward?
It was incredible being down there for the Snowflake Startup Competition. It was really encouraging to see where they're going with their ecosystem, and what they're doing with native apps specifically is where we're kind of going to market with them. And the support network for me was the biggest takeaway. It was once we met with them and we were like, we're going to work together. It was just everybody piled in and we got the job done. So I was very encouraged, and I know Brent can speak for that as well. It was knowing that we picked the right ecosystem to go to market with. Snowflake was that for us.
Now, Brent, the data center and cloud landscape is evolving rapidly. How does Big Geo's technology align with the future of data centers? And what role do you envision for your company in this transformation?
It's an incredible technology for the data center space. I mean, we're having these conversations on a daily basis with some of the world's largest hyperscalers. Our technology sits right up against, it's built on first principles solutions from the ground up to increase performance at the data center. So we're looking at this technology as a way to reduce the amount of electricity consumption for data centers when it comes to geospatial performance, which is vastly becoming or quickly becoming one of the largest computing workloads at the data centers. So it's a very important technology to align with our hyperscaler partners and give them more, save them on electricity so they can spend that on artificial intelligence. So,
all right, now, Brett, we're here at the New York Stock Exchange.
It's
You're
awesome.
on the trading floor.
It's awesome. I've seen all the movies.
Well, tell me, how does it feel to be here? And how does this experience align with Big Geo's goals and vision?
Well, first of all, it's great.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. We are moments away from the opening bell, and when we look at that podium, we'll see NYSE-listed investment giant BlackRock celebrating the market open. The firm is here to celebrate a pair of new ETF offerings that debuted in late October. The iShares AI Innovation and Tech Active ETF, ticker symbol BAI, selects a concentrated portfolio of global AI and technology equities across all market capitalizations, chosen through bottom-up research-driven fundamental investing. Meanwhile, the iShares Technology Opportunities Active ETF, ticker symbol TEK, selects a portfolio of tech companies consisting of both established leaders and high-growth disruptors that innovate across all market capitalizations and geographies. In total, iShares has 239 ETFs with more than $2.1 trillion in assets under management listed on the NYSE Arca. Well, today's bell ringer, Tony Kim, is the head of BlackRock's global technology team within the Fundamental Equities division of BlackRock's portfolio management group. He's the lead portfolio manager of the BlackRock Technology Opportunities Fund and related global strategies. All right, you're taking a live look at the bell podium there as we are set to get off to the races of trading. Let's listen in as BlackRock celebrates the opening bell. All right, stocks are officially open for trade, and joining me now is our resident expert, Jay Woods. He's the Chief Global Strategist at Freedom Capital Markets. Jay, always good to have you, especially as we start to wind down earnings with a lot going on.
Yeah, there is a lot going on, and we're getting a little bit of a rally, and it was a nice little bell behind us to kick things off. Yeah, earnings season has been the focus. We had 91% of the S&P 500 already reported before this week. The big one was the big stock, the biggest weighted stock in the S&P 500, a new member of the Dow Jones Industrial Average, in NVIDIA. They had earnings that beat on all metrics. The guide was a little lower than some anticipated. It was seeing a little bit of a sell-off after hours, made that up, and it was trading a little higher as reopened activity today. That is a good barometer of health in the tech sector, in the semi space, and for the overall market. So it looks like this hangover we had after the election rally is starting to subside, and I think the bull market is about to take us to 6,000 over the coming weeks.
Interesting, Jay. Okay, so obviously optimism from NVIDIA would help that. What else can take us to new highs?
Oh, well, the financials continue to lead. We've seen great earnings from the financials, and the regional banks are starting to catch up. Then watch the small caps. I've talked about it way too much, that they're finally going to catch up. We're finally going to see new highs. But that's exactly what's about to happen. They're about 3% off all-time new highs. I think by the end of this year, probably a lot sooner, we're going to see that. And then crypto-related stocks continue to lead this market. It's been a bit of a frenzy, getting a little too frothy. But once Bitcoin hits 100,000, it's almost inevitable now. It took to 98,000 this morning. We may see a little bit of a pullback, some profit taking there, but there is a frenzy in some pockets. But overall, the economy continues to do well. We're going to focus on economic data now that earnings season is behind us, and then retail earnings were also a story this week as well.
It's interesting. We got to talk about the Fed, right?
Yeah.
It is always in focus for our viewers and investors, and we had seen earlier this week that expectations of a December rate cut had actually fallen to just about 55% as of yesterday.
Yeah.
How does that impact the path forward for stocks?
It causes a little bit of a headwind, some turbulence there, if you will. But for me, I don't think they're going to cut. I don't think they need to cut at this December meeting. We've seen data that's kind of stabilized. The CPI data came in as expected, but it ticked up. The PCE is supposed to tick up from 2.7 to 2.8% next week. That will be a key data point. If that comes in above 2.8, then there's no way we're going to get that cut. But the Fed has been doing its job. We talk about this soft landing narrative, getting inflation down to 2%, keeping unemployment stabilized. Well, unemployment is stabilizing. Jobless claims. We got a mixed signal today, just a few minutes ago before we jumped on, where continuing claims actually were elevated, but the jobless numbers were down. So we'll see. There's no urgency to cut at this point in time, but 50-50, we'll see what those odds are at the end of next week.
You know, when you joined recently, Jay, you had mentioned at the start of November we were beginning the best 6 months of the 12-month stretch.
Yeah.
Is that still true given the decisive actions and results that we've seen in the past few weeks?
Yeah, I believe that to be the case, because what we're going to see now, besides the economic data, you're going to see money managers have to chase performance. This is one of the best years we've had in quite some time, best election year we've ever had. So what they're going to do is they're going to rebalance their portfolio, look for leadership, and then what has been lagging, some of the semiconductor stocks have been lagging. We may see a rotation into that. But what we've seen during this bull market is rotation, and we've seen utilities come to the forefront. Now energy's been leading for the last 2 weeks. This is healthy. This is the lifeblood of a bull market. So I anticipate, money managers are going to go into some distressed assets, look for, strength, software in the technology sector, cybersecurity in the technology sector continues to do well. Now, if the semis can pick up the slack with NVIDIA leading them, that's where you want to see the leadership.
I'm glad you bring up a good point there, that NVIDIA is now officially part of the Dow.
Yeah.
Dow, of course, is a price-weighted index. The S&P 500 is an actual market cap-weighted index. How does that impact the dynamic of how these two indexes trade?
No, it's a big distinction. You have to look at it. So when you say price-weighted, meaning the highest price stock, Goldman Sachs, United Healthcare, when they move, the Dow will move the most. Now, it seems like they should be very there should be a large discrepancy between the two indexes, but if you overlap them over the last 50 years, they go pretty much hand in hand. The S&P 500 market cap weighted, so NVIDIA is the biggest stock market cap weighted, a 3 trillion plus company like Apple, like Microsoft. So those stocks give more impact to the overall index of 500 stocks because they're the biggest companies out there. So the Dow does things a little differently, but at the end of the day, the weightings, they seem to be all right. But fun fact, NVIDIA is like the 20th most important stock in the Dow because it's $148.
Yes.
Where Goldman and United Healthcare are the most important stocks because they're $500 stocks. Yeah.
So different though, because it's 7% of the S&P 500.
Yeah, well, I like the Dow because it's only 30 stocks, and it's
Yeah.
30 of the biggest stocks, and it's a very diverse group of stocks.
Yes.
The S&P tends to be tech heavy because the biggest market cap weighted stocks happen to be in tech. So they both are great indices. I think the S&P 500 is more of a microcosm of the U.S. economy, but they both work, and they're both important to watch.
Jay Woods, always a pleasure breaking down the action we need to know here at the New York Stock Exchange. Jay Woods is the Chief Global Strategist at Freedom Capital Markets. Thank you. All right, well, in other news, NYSE-listed HubSpot celebrated its 10-year listing anniversary at the stock exchange earlier this year. The company, which has over 238,000 customers around the world, provides software and support to help businesses. HubSpot, which reported its latest quarterly earnings earlier this month, says its revenue during the third quarter rose by 20% year on year. HubSpot is also making moves in the AI space as it aims to embed AI into every hub and across its entire platform. Our Judy Shaw standing by on the trading floor with more on this story. Good morning, Judy.
Good morning, Kristen. Kristen, I'm here with Nicholas, as you mentioned. Nicholas, wonderful to have you on NYSE TV Live. I want to start off by talking about AI agents. They seem to be gaining traction as the new apps. So talk about AI agents and why they're gaining this traction.
Thanks, Judy. So HubSpot basically thinks about AI and agents as a way to kind of help the SMBs. We've always been like a champion for the SMBs and helping them grow. And agents are really kind of AI-powered automation 2.0. So a couple of easy ways to think about it is we have agents here at HubSpot that help you do content marketing. So right out of the box, SMBs can have something that makes landing pages for them. It can do blogs, it can do research. We also have agents that do something like prospecting. So whenever a small business is trying to reach out and book a meeting, we have an agent that will reach out, it's personalized, it understands the customer, and it'll book a meeting. The other one that's really cool is that we have an agent that is what we call a customer agent, and our businesses have people that have issues. They come and they say, oh man, something's not working, and they want something to help them. And we have a customer agent that you feed it knowledge, and it can resolve issues and help out. All of these kind of give our SMBs superpowers, and that's what we've always been about here at HubSpot.
And where are you seeing the most impactful use of your tools across your customer base?
So AI is really taken off, especially for the SMB space. We have a third of our customers now that are using AI on the regular. An example of that is like we have something that we released at Inbound called Breeze. And Breeze, our job is to make the SMB's life easier. That's why we named all of our AI tools that. And part of Breeze is something called HubSpot Copilot. It works, it's like your AI BFF. So all of our SMBs use Copilot to do things like create reports, talk to their CRM, make content, things like that. And so one of the things that's nice about that is that effectively the Breeze and the things that we do help our customers grow and unlock more creativity. So I'll give you an example, like Kaplan is one of our customers. They use Breeze and HubSpot Copilot to also be more effective, but what they said was Breeze was the first time they started helping their their employees become AI first thinkers. And that's a big part of what we're trying to do is help that SMB realize that AI is a tool just to help them be more productive.
Talk more about how your tools are supporting growth in the SMB market.
Right. It's tough being an SMB. You know, you've got competition, you've got all sorts of macroeconomic factors. What's most important for our customers is how do you make things easy? They want to really get started and make things easy for their employees, fast to value. And what they also want is everything to be on one platform, unified. They don't want a bunch of different tools and have to go to all these different places. So when customers come to us and they're talking about HubSpot, they want a single platform to start that relationship with a customer, and they want it to go all the way through to repeat business, and they want everything to be unified. And so that's what we do.
And why is the SMB market such a focus for HubSpot?
You know, there are many companies that focus on the enterprise, and there are a lot of tools that help kind of the startup, et cetera. who champions for the SMB. It's a really interesting space where they need things that are easy, fast, and unified, but they also need things that are powerful as well. They need people to meet them where they are and grow with them, and that's always been one of HubSpot's superpowers. The way we think about that with AI, for example, is how do we bring AI to the table, make these agents kind of demystified, and let them unlock their growth and creativity? That's what our big mission is, and that's what we're excited to do.
All right, now the end of year is approaching. We're looking ahead to 2025. So what are you focused on? What are your priorities?
There are kind of two big things. So there's lots of people making sales, marketing, software, et cetera, but very few people bring all of that together. There's a lot of value at the intersection where those things come together. So in 2025, we want to basically help bring marketing and sales teams closer together. The other thing that we want to do is we talked about the agents. So it's not just about a few agents, it's about a whole agent ecosystem. So imagine an SMB now has an entire buffet of things that they can choose that helps them get lots of their jobs done. That's going to be where we think 2025 is that the SMB can go out there and they can pick not one agent, but many agents to really help them grow and punch above their weight. That's what we're excited about.
All right, well, it sounds like a lot of exciting things happening over at HubSpot and lots to look forward to. Wonderful to have you here. Thanks for joining me, Nicholas.
Thank you, Judy. I appreciate it. Cheers.
All right, Kristen, back to you in the studio.
Judy, such great take there. Thank you so much for joining us on the floor. And stay with us, everyone, because coming up, BlackRock's U.S. head of thematic and active ETFs is going to explain his company's products that help investors get ahead of 2025's major storylines.
What you need is the commitment of all the employees that it's a priority, that we value culture, that it's a differentiator, that it helps us better support our partners and our customers. And I think all 20,000 people truly believe that. And so we're focused on it. But you have to be willing to change too.
Yeah.
And, you know, that's always one of the challenging parts. When you think you have a great culture, it's easy to say, okay, let's just not break it.
Yeah.
But if you just say that, you say, let's just not break it, okay, then you're not evolving, right? And the world around us is changing every day. And you have to respond and react to that. And that means you have to do that for the business and respond to those external dynamics, but it means you have to do it for the culture as well.
Yeah.
You know, we've been through a very difficult few years as a country, and that means that you need to support your employees differently given those circumstances. But I'll tell you, it's really important to listen to that cohort, because their needs and the pressure that they're under is very different.
Yeah.
And that's where I think, you know, we add a lot of value. And we add a lot of value to those partners, even outside of the credit program. Like, we can actually help them on other topics. Mm-hmm. You know, HR, finance, you know, other things that we do where we have a more established process will help our partners. And we do that just in the spirit of partnership. But it means a lot to that group, because they do have a totally different set of demands. And one of the things we did in the reorganization is we realized that a lot of what they need and a lot of what we needed to do to support our partners was common across industries. The customer experience has never been more important than it is right now. There is very little friction.
Welcome back to NYSE TV Live, everyone. I'm Kristen Schuller here in studio. And moments ago, BlackRock rang the opening bell to celebrate the launch of two new ETFs, the iShares AI Innovation and Tech Active ETF, and the iShares Technology Opportunities Active ETF. Well, Jay Jacobs, U.S. head of thematic and active ETFs at BlackRock, joins me now in studio with more and to talk about some of the major storylines as we head into the new year. Jay, welcome.
Thank you for having me.
Look, I think NVIDIA is top of mind for many of our viewers and investors these days, specifically because it is the purest play in the market on artificial intelligence. How is that shaping your ETF role at BlackRock?
Well, I think what investors need to recognize is, yes, there's some Mag 7 mega cap tech stocks that really drive the AI story today. But if you look out 3, 5, 10 years, there's going to be a broadening of artificial intelligence that really lifts up dozens of stocks, not just in the United States as tech stocks, but even globally and across other sectors. So bringing out a fund like BAI, which is an actively managed AI ETF, allows our portfolio managers to really anticipate what will be the next major leaders in artificial intelligence going forward.
And what are those leaders expected to be?
Well, it's going to be across the entire tech stack of artificial intelligence. So if you look today, a lot of the early winners are semiconductor companies as well as model developers. These companies are building these large language models. Going forward, it could be other semiconductor companies that are playing different roles within the AI ecosystem. It could be companies developing data centers. It could be companies building very niche models that are not designed for everyone to use, but maybe very specific use cases. And I think what will be the most interesting is what are the companies that build products using artificial intelligence going forward. If we think about what happened with the rise of the mobile internet, you had all these new companies in social media and e-commerce that really were born because people had fast cell phones in their pocket. We think there's going to be a similar revolution in AI where entire industries are built using artificial intelligence as their underlying technology.
How does that allow investors to really look beyond the Mag 7, which has driven so much of the market gains that we've seen since this bull market started 2 years ago?
Well, that's exactly the point, right? The Mag 7 has gotten so much of the attention and has driven so much of the returns, but really some of the best opportunities going forward are going to be beyond that Mag 7. So it's really about investors, whether it's through our BAI actively managed ETF or looking at other plays around the world, trying to anticipate who wins in the next few years. And it's not just going to be the Mag 7. This is a economy changing trend. We call it a megaforce, and therefore we think dozens of companies are going to be impacted by this.
Are there certain assets that you think people should be shedding to gain exposure to artificial intelligence?
Yeah, so what we see a lot of investors doing is kind of cutting back in two ways. One is cutting back just on their core exposures because so much of the broad market indexes are in the Mag 7 today. About 30% of your core equity, US equity holdings are in the Mag 7. You can sell that down a little bit and replace it with an artificial intelligence ETF that's going to extend beyond the Mag 7. The other way people are looking at it is if you have a tech sector allocation, reducing your tech exposure and increasing your artificial intelligence. Because there's a lot of tech within AI, you get to replace your kind of sector risk, but you get to have more exposure to a high growth theme by replacing tech with AI.
Talk to me more about active management versus some of the indexing management that we've seen.
I would say the first kind of generation, the first era of ETFs really was based on index investing, getting broad exposure in low-cost wrapper to big swaths of the market, S&P 500, et cetera. Now what you're seeing is that actively managed, active portfolio managers are bringing their strategies into ETFs. This means that through the tradability and accessibility of an ETF, you can get access to world's leading portfolio managers, which previously were harder for investors to get exposure to. So this is really about democratizing access to actively managed portfolio management.
And as people look at their own investments as we head into the new year, what has worked, what maybe they want to reposition, and goals for 2025, what would you recommend to them?
Well, I think there's three kind of overarching themes people should keep an eye on. One is absolutely artificial intelligence. We are full steam ahead in the build out of AI in 2025. There's going to be hundreds of billions of dollars being spent to build out this megaforce. But people should also be looking at two things. One is, how is the physical economy in the US being reshaped? This is about investment in infrastructure, investment in manufacturing, investment in home building, because there's just a lot needs to be built in the US. And the third thing people should be looking at is, as we enter a rate cutting environment, how does that impact things that were, frankly hurt in the rising rate environment in 2022 that now could have a tailwind? That's things like biotech stocks that benefit from low interest rates. It's also things like Bitcoin that might benefit from low interest rates as well.
Interesting, Jay. Top questions that you're finding your clients might have in this environment, what are they?
They're trying to figure out how to kind of repeat the returns they've seen over the last decade, which largely they got from investing in broad US equities. Now there's a view that you have to get more granular. You have to look at kind of more niche parts of the market to access the returns that we need to achieve our financial goals.
Jay Jacobs, great to have you on the show. Great to see you in person. Of course, here as BlackRock celebrates the opening bell and we're off to the races in the trading day. And Jay is the U.S. head of thematic and active ETFs at BlackRock. All right, well, buckle your seatbelt because up next we have something fun in store. The senior editor of Motor Trend is going to join me to explain how one vehicle in particular earned the company's Car of the Year award. Stay with us.
So we're not following a cuisine, we're actually really leverage the culinary art form of churrasco, which is very traditional Southern Brazilian cuisine. We've been doing it for 45 years. So you're right, we only have 72 restaurants in America, but 96 globally. But our whole essence of our brand is about scaling the authentic culinary art form that we know our guests love around the world.
When it comes to cuisine, there's many different trends out there, right? Especially as people are more health conscious these days. So how are you keeping up with these trends, but still being true to your brand?
What we love about it is everything we serve is nutrient dense and good for you. So it's up to you and your diet and how you like to dine, but we've done that for 45 years. What's exciting is our innovation around that is even getting better. We've just rolled out whole branzino seafood, so we're just now beginning the fresh seafood platform, and we're really excited about that.
Ooh, that sounds delicious.
Yeah,
we're going to have to try it when you
will.
Open up your new restaurant.
That's
Just,
right.
a block or two away?
That's right.
Yeah, talk to me about when that's going to be opening.
We're opening by probably like middle of December, but it's World Trade Center. Really excited. So it's our second one in Manhattan. We have one in Midtown. It's 18,000 square foot. The one in the World Trade Center is ground level. It will be about 5,000 square foot, so really excited to open that. Can't wait to host you there.
Now, you've experienced significant growth in recent years. We talked about over 90 restaurants worldwide, over 70 here in the United States. What would you attribute your success to, and how do you think you're going to continue this momentum?
We scale our culture first by really investing in our people. A lot of training, because this is an art form that is unique to us. We're the category leader in it, and we are scaling it globally. So when you think about how to do it well, to keep the authenticity, we focus on our human capital pipeline first. Now we have visibility of 3 years of sites ahead of us because we have 3 years of people, I would say talent ready to do it.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. Well, we are just about 25 minutes into the start of trade, and let's take a look at stocks to see how they're faring. We do see a muted market with an upside bias. Of course, comes after major earnings from NVIDIA, that company beating on the top and the bottom line, the purest play on artificial intelligence in the market, and of course, the most heavily weighted stock in the S&P 500. That company also had good guidance. Well, on Wednesday, automotive media platform Motor Trend named its 2025 Car of the Year honoree, and the winner is, drum roll, the Mercedes-Benz E-Class. It's the second time in 5 years that Mercedes-Benz has secured Motor Trend's golden calipers, and this is also Motor Trend awarding a Car of the Year annually since 1949. Motor Trend senior editor Justin Westbrook joins me now in studio. Justin, great to have you on the show.
Thanks for having me.
We've got a lot of great video lined up of this vehicle. What makes it the Car of the Year?
So for Motor Trend, what makes a Car of the Year for us, we really focus on 6 key criteria. That includes safety, value, engineering excellence, efficiency, performance of intended function, and advancement in design. So for the Mercedes-Benz this year, their E-Class, the design is advanced, both interior and exterior. They have new screen real estate. They have these fold-away cup holders. You can put your phone and a wireless charger away out of sight. It's very luxurious, very elegant. And then in terms of safety, it's always been one of the safest mid-size luxury sedans on the road, so that continues this year. Value, it comes out of the gate with tons of standard features, tons of safety features, advanced driver assistance features. It'll even change the lane for you if you want, just by hitting the little indicator while it's driving itself. It's really fantastic. And then value, again, I said, it also comes with all these excellent options on top.
Yes.
So for a luxury customer, it really provides everything you could ask for.
What is the price point, the range for that luxury customer on this vehicle?
This one started at $72,000. The wagon version we tested started around $78,000. And then, like I said, for value, you can really option them up. So as tested, we were getting close to 6 figures. But the base value of the car is you do get those safety features, you do get those luxurious appointments, and you do get a really refined ride just for $72,000.
What came in second and third? to this vehicle?
We don't necessarily rank them in that order per se, but this year was very competitive. We did have a very competitive BMW i5, the electric version of the Mercedes E-Class competitor from BMW, and it just wasn't as good. And we had a Porsche Taycan, you know, very high performance electric car, but that was just a little too pricey, a little too much performance maybe for, and then it just didn't meet our criteria the same way the Mercedes did.
Have you ridden or driven this vehicle, the Mercedes Honoree?
Yeah, I was one of the judges this year at Car of the Year. So I drove this car against about 30 other competitors back to back. We test on a proving grounds that's developed by an automaker, so we test on the same thing that they develop their vehicles on. And then we also test in the public roads. So we have a loop out in California where we go on highways, we test the safety systems. It's very thorough, and we picked a winner.
Interesting. What are you seeing broadly in the auto space right now in terms of trends and demand?
So obviously electric vehicles were the big trend. Self-driving vehicles are going to be a big conversation going forward, especially with the Trump administration reportedly saying that they want that to be a focus early on. So we'll be looking into that on motortrend.com and keeping it covered. But in terms of electric vehicles, we've seen companies now scaling back a little bit. There's still investments there for electric vehicles. Electric vehicles are still coming. They're still the future. They still are really refined. They handle really well. But maybe there will be a little more room for hybrids and gas vehicles a little bit longer than expected.
Interesting. And what is driving that? Is it market dynamics? What is behind that?
Early on, it was supplier constraints. You know, we had all those stories, especially during the pandemic, where companies were having issues getting their supplies to build these vehicles, to get them on the roads. So when you're emerging a new vehicle, you don't want that. But now that's mostly been taken care of. Now the idea is getting that price down, getting that infrastructure built so that these vehicles are easier to own, easier to afford, and better for the American.
Okay, any other bells and whistles our viewers need to know about this vehicle?
It's, like I said, it's got a ton of great tricks. It'll change lanes for you. It's got massaging seats. It has programmable functions. I'll finish with this. It has programmable functions where you can have it roll down the window when you know you're going to pull up to a gate automatically, or it'll turn on the heated seats at a certain time when you get out of the gym, stuff like that. So it's very cool. It's very thoughtful, very owner-oriented.
But I like that, not just heated seats, massage seats.
You can also get massage seats. Mercedes offers, I think, quite a few versions of their massage seats, and they'll even do lumbar support, so it kind of shifts your seating position over long journeys to keep you more comfortable.
So this is good, you think, for someone who is taking a long trip or more for a city?
This is perfect for
driver?
everybody. The hybridization means it's more efficient. You can actually run without the gas engine for a little bit, so it's perfect for city driving, you know, just scooting around. Very quiet, very refined. But then on top of that, it still has the gas engine, it still has the range, more than an electric vehicle. So it can do it all.
Wish we could take a spin, Justin. I guess
I know, maybe one day.
Have to save that for another day.
Yeah.
Justin Westbrook, he's the Motor Trend Senior Editor. Justin,
thank you so much.
All right, well, that's going to do it for today's show, everyone. Action-packed as always. Thank you for watching. This is NYSE TV Live. I'm Kristen Scholler here at the Stock Exchange, signing off as stocks are fractionally higher with those blockbuster results from NVIDIA. Thank you for watching. As always, check us out on YouTube.
In life, I'm reminded that it's not about the destination, it is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital markets here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege to be with you.